Well, it's actually particularly relevant for today's market. You started by talking about where oil prices were, and we've got a conflict raging in the Middle East, and people are talking about oil prices. There's a lot of volatility in the market, and the discipline is how you look through the noise. I think human nature is we want to control these things. We want to create the illusion of certainty, and the discipline of understanding how you enter these periods of time with some confidence that the portfolio is going to be resilient through these periods of time. It gives you a chance to not make those rash decisions, and that's the central issue.
So what are the conversations you're having with your clients over the last 6 weeks as we navigate this black swan, which is Iran here? What are the conversations you're having?
You know, someone asked me this question last week: how many times are you getting a call from a client today? And the answer is surprisingly few. So a lot of our clients, these are generational wealth creators. We work for a very specific type of client, and they are really long-term investors. A lot of people say they're long-term investors, but when they get punched in the mouth, they got to react. And so it's surprisingly few phone calls. Okay. And so our clients have been with us through periods of time, volatility like this. And so there's a calm to it. And quite frankly, they understand that there is no crystal ball. I can't tell you where oil prices are going this afternoon, tomorrow, but we can look through this stuff and have some confidence to understand what a new normal might look like.
One of the issues, if it weren't for the Iran war, Tom and I keep discussing, is private credit. And maybe is that a systemic risk that maybe we're not paying enough attention to that may come back and bite us at some point in the future? How are you advising your clients on just the credit quality, the private credit markets in general?
It's fascinating. Without the conflict in the Middle East, this would be the thing that was driving this and SaaSmageddon, all the disintermediation of the software companies. Fortunately, we had a view on private credit that goes back years ago that we had none of it in the portfolio. So we had views on the asset class that you weren't really being paid to take what we consider to be lower quality companies, higher leverage on the balance sheets. And so our clients have zero exposure to private credit, which is shocking to some people who are in this business. And so we come at this position not in a defensive posture, but being able to analyze these things, I think, quite rationally.
You did a tour of duty at Nuveen. Great Cubs tickets. Sure. Oh my God! You did a tour of duty at Nuveen, and I want to talk about Nuveen and the magic of duration, and you guys invented
I love the bond
speak and all that. Bring duration over to the equity market, not bills, notes, and bonds, but define how we should look at the timeline in the stock market now.
Yeah, it's a really good question. I don't think people pay this enough heed when they're thinking about investing. For our clients, they are long-term investors. And so when we think about this, we actually have to build portfolios that are not for 1 year or 2 years. We have to think about this in generational terms. And so when you think about building a portfolio like that, you stop thinking about tomorrow's prices and you start thinking about economic regimes, for example. Do you have balance across economic regimes? And so when you add that kind of duration to the portfolio, you start thinking about, well, in a low inflationary environment, how are we balancing for inflation? Or in a high growth environment, how are we protecting against a low growth environment? And so if you build that sort of balance in portfolios, you can create the duration to create resilience.
But a la Charlie Munger, if you do what you just said, you take 500 Standard & Poor's stocks, and I'm saying you squeeze them down in that duration demand to a select group of securities. How select is that group, 500 down to X?
Well, recently it's been incredibly select, as you know. People have been talking for 6 or 7 years about MAGA and the AI concentration. I think the fascinating thing about your comment about 500 stocks is that people buy an index today, or passive representation, and what they're buying when they buy the S&P 500 is not a broad representation of stocks. It's highly concentrated into a few names. That may not be a bad thing, but it's not probably what most people are signing up for.
So do you guys have a model, I guess, asset allocation, stocks, bonds, alternatives? How do you guys think about that?
No, it's really fascinating. When you work for these generational families, there is not an allocation for a family. First of all, every family is different. But then within each family, you could have G1 assets, meaning first generation assets that are much more conservative and much more liquid. Then you're thinking about generational assets and dynasty trusts and things like that, and they're much more aggressive. They have fewer liquidity needs. And so even within a family, you could have vastly different investment policy statements and positionings across the family.
How many clients do you have roughly?
So we have about 130 families, and it's about $14 billion in assets. And so you can do the math on it. I got to tell you, it's a great group of clients. So most of them are first generational wealth creators. So we have fabulous stories of scrap metal businesses and people coming from nothing to create this. It's really fun.
That's amazing. So
You should see their Cubs tickets.
yeah, Cubs tickets, exactly.
Get one more in there. We're going to get to Ellen.
So how are those types of families, that type of wealth, what is the risk profile these days?
I'm going to go back to what I said before. It's not homogenous across a family. So again, if you made this money, the fascinating thing to me across all these families is there is a commonality of I made it and I need to protect it. And it doesn't mean I don't want to take risk. In fact, we have some very risky portfolios across our families, but there's this idea of not doing anything stupid and avoiding the permanent impairment of capital. And it's a really fascinating thread to deal with.